We are a collective group of people who have come from such different backgrounds in financial markets. So for example, heading up our government bonds is Tim Hext, who's got over 30 years of experience in global fixed interest markets. So he knows the inner workings of governments really well. And so this really helps our government bond franchise do well in an environment where there is much to be made through the macro environment as there is to knowing the minutiae and the details of what's going on in the government bond market. And then you've also got Steve Campbell, who is cash manager extraordinaire, and he heads up the cash franchise of our team with great expertise with the short end of the market. He's on top of what the RBA is thinking and what they're likely to be doing. And then we've got George Bichet, who comes with really high credentials in terms of ESG and impact investing, but he has long-standing experience of Australian credit markets as well. And then myself, I come with experience of over 20 years in the markets, both offshore and onshore. I bring together a lot of the expertise within the team in our income strategies, which aim to provide investors with stable income, but also pretty good capital preservation and capital growth as well. So my approach to risk management is all about decision making. I think without a strong decision-making framework, you can't have a good risk management framework. Think about the range of possibilities that might await you on the other side, and then try and build your conviction for your original investment thesis. If you can build it, then assign probabilities behind it. And if you can build it, you can also see what can go wrong. So being prepared for what can go wrong ahead of time, and being prepared and knowing what you will do and how you will execute your strategy even when things go wrong, is all part of what I think is a good decision-making framework and therefore a good risk management framework. We have a range of both qualitative and quantitative tools because, as you know, the information never stops in markets, but you've got to have a really efficient and, most importantly, objective way of looking at that information so that you can arrive at sound investment decisions. So within our toolkit, as well as the qualitative expertise of our entire team, which stretches, both geographies and timelines, it's also about the quantitative toolkit that we bring. So we have extensive numbers of models that gives us hints as to what way to position that may be more favorable in the future compared to others. And as a result, it sets us apart because it gives us a slight edge in terms of, how we react to market events as and when they come up. And having this very robust toolkit of both qualitative and quantitative models at our disposal, it means that we can navigate the entire market cycle. So I've had over 20 years of experience in this industry. I actually started off on one of the largest trading floors in London. I've also traded for a hedge fund through the global financial crisis. And now I'm here at Pendal managing total return income strategies. And what I can tell you from the experience that I've had over these last 20 years is that there are probably 3 lessons that stay with me every day and help me make good investment decisions for my funds. The first one is that there will always be a lot of noise. Noise is everything and everywhere, but so are signals. So if you can come up with a good system of identifying the signals and working your way through the noise, it means that you stand a good chance of staying upright and finding your way when the rest of the market becomes really rudderless. The second lesson is probably that change always happens and you should just be prepared for it. I think the hallmark of a really good active investor is that you use change and volatility to your advantage rather than stumble or become sort of deer in the headlights because of it. And the third lesson, which is probably my most important lesson, is about a good decision-making framework. Let me be clear, a good decision is not defined by a successful result. You can make good decisions and still have a bad outcome. But a good decision-making framework means that you can make a string of decisions, and it's more likely that you end up with a string of good results rather than a string of bad ones. And I think if everything that we do for portfolio management is about making good decisions, that means that we can guide our portfolios through turbulent times, through more uncertain times, and it means that our investors can have a more sleep at night frame of mind when they're in our portfolios. So the monthly income plus strategy is Pendal's flagship income strategy. Now, all investments carry a degree of risk, as we all know, but the monthly income plus strategy sets out with 3 very clear investment objectives. The first one is that it must pay a regular income. So this income fund has been around since 2010. It pays income on a monthly basis, and never in its life has it missed an income distribution. The second objective is that we must minimize drawdowns. Drawdowns can happen in markets for any kinds of reasons. You saw it in the worst financial crisis, which was the global financial crisis in 2008. But since then, you've had several turbulent times in markets as well, whether it was during the Trump trade wars or more recently during the COVID pandemic. Through all of those times, we aim to chart a more stable course of returns for our investors. So we really have risk management at the heart of our priorities for the monthly income plus strategy. The final objective is related to the second objective, and it's about minimizing the amount of time that this strategy stays in drawdown. Now, drawdowns will happen in markets for all kinds of reasons, but we want to minimize it because most investors in this fund want to see their capital grow over time, not shrink. To be aligned to their investment objectives, we have to make this one of ours as well. Now, the income component of the monthly income fund has made it a great hit with retirees and pre-retirees alike. But over time, because of its strong return dynamics, and especially in more turbulent times, being able to generate returns consistent with even, Aussie equity markets or even global high yield markets, it's started to appeal a lot more to a broader audience of investors as well. And because we have risk management at the heart of what we do, people really appreciate that this fund carries a strong level of a focus on stability and capital preservation, especially in those more turbulent times. And so for our audience of investors, advisors will typically use this fund almost as a standalone allocation for their investors who are at the more moderate to conservative end of the risk appetite spectrum, who are focused definitely first and foremost on income returns, but really want to preserve and grow their capital over time as well. But we'll often be paired with other types of fixed income strategies as well, because we tend to be more active in our interest rate exposures.